Good morning. Welcome to our tax workshop. We've got Brenda presenting today.
Thank you, Rocky. My name's Brenda Hunter. Most of you know who I am. But I own a business in downtown Oxford, and we do all kinds of accounting and taxes, all kinds of taxes, personal, business, trust, estates.
Oxford Strong.
Oxford Strong, that's right. I do have some copies of this presentation out there if anybody wants a copy to take home, just so they get to have the information. So here's a copy of the tax brackets for 2023. They change every year. They go up slightly. They're slowly bringing the tax brackets up every year. They say for inflation. They haven't changed these numbers on the left. There's like 7 tax rates over here, and they just keep bringing these up, raising everybody's taxes, trying to pay for all the government spending that we have out there. This is the dividend and capital gain rates for 2023, and the rates they haven't changed. They keep talking about getting rid of the 15%. They have not done that, but again, they keep changing the amounts that you can make in order to stay in those brackets. And keep in mind that there is a 0% rate that you can be in, up to 44.6 for single, 89.2 for joint, that you can make in capital gains and not pay any tax. The standard deduction goes up every year. So for 23, that standard deduction for singles, 13.85, joint 27.7. There is an additional amount for if you're over 65, and that's at the bottom here. So it's an extra $1,500 for each party. So if you're married, that would be an extra $3,000 you would get on top of that. Estate and trust rates, again, these, if you look, obviously these bump up pretty quick to be pretty high. They pretty much start in the 24% bracket and go up 35, 37. This is why we do generally, unless there's a reason, irrevocable trust, there's obviously reasons to do that, but we often do suggest that you do the K1s and put it on the personal returns. Usually they're in a lower tax bracket than the trust themselves. At the bottom, I have the gifting limits for 23 and 24. We get a lot of phone calls on this. In 23, the limit was $17,000 per person, and 24, it's $18,000 per person. If you're a married couple, you can each gift that limit. So if you're a married couple, you could gift $36,000 or $34,000 and $36,000 per couple to one of your children.
Individual?
Yep. Mm-hmm. So to your children, and you can do it to each. So if your child is married, you could do it to both of them. Same with a grandchild. So you could actually gift quite a bit of money in 1 year if you were trying to do a spend down. But as I'm sure you're all aware, Social Security will do a 5-year look back on gifting. The lifetime exemption in 23 is $12.92 million. 24 is $13.61 million. So the way that works, the reason they have these gifting limits is for gift tax returns. So you don't have to file a gift tax return if you gift less than the 17 or 18,000 per person. The $12.92 million is what they use in a lifetime exemption to pay tax in your lifetime. But if you gift more than the 17 in 1 year, you have to file a return and just let the IRS know that you've gifted more than that amount. There's no tax due unless you go over this $12.92 million, which I don't know that anyone's gifting that much, but maybe we honestly have had people. But what they're trying to do is keep track of how much you're gifting. So if you gift more than that amount, you just have to file, let them know you've done it, and it comes off your lifetime exemption. In 2025, these current lifetime exemptions are going to expire, and right now it's going to go back to about $5 million unless they continue on to the current bill, which is slowly increasing every year for inflation, which is why it goes up every year about $1 million, almost $2 million every year. So if you gift, it's not taxable to them, it's not a deduction for you, but if you go over these amounts, you have to file a return and just let the IRS know what you've done. It's a 709 return. Child tax credit. A lot of people your age probably think you don't need to worry about the child tax credit. However, this $500 here is for other dependents, not necessarily. Could be a child that's disabled. It could also be another dependent. It could be a parent. It could be a sibling that lives with you. It could be anybody that you care for that you are considered pay more than 50% of their support. You can take them as a dependent and you get a $500, what they call a child tax credit. That credit is partially refundable. They're going up to the $2,000 though. The $500 is not. Right now it's $1,500 per qualifying child, and you must have at least $2,500 in earned income. That started in 22. You never had to have earned income before. Now you do, but there's a bill right now sitting there. It was passed by one, not the other. It could make that $1,500, $1,800 of refundable and take away the $2,500. So we're trying not to file any of those returns till we know for sure, so we don't have to redo them. This credit phases out at income levels of 400 and 200. The net investment income tax. So we sometimes get these questions on the returns. So, some people's income, it goes high and they're like, well, I've got tax and then I've got this line that says other tax on my tax return. So I just want to explain this to everybody, what that other tax is. If you're single and your income is over 200, married filing joint and your income is over 250, back about maybe 10 or more, I don't know how many years it was, Obama started the thing with the marketplace insurance, and this is for people who don't have insurance. They have to have insurance, so that's what they started that rule, had to have insurance to pay for the people who don't have health insurance. People who they consider high income have to pay 3.8% more if their income is over these thresholds. So that income could be a combination. If it's earned income, they pay 3.8% Medicare tax on the earned income, or it also is figured on capital gains, interest, dividends, rental, or passive income. So that you could potentially see that on your tax return, and that's what it is. It's only on the portion over the 200 or the 250. You're paying that 3.8%, and that's to cover people that don't have health insurance. It also affects estates and trusts and income above those income levels. Cryptocurrency, probably not a lot of people in this room have this, but the IRS is still on the hunt for people that do. Every single tax return, we have to check a box. We're supposed to ask everybody if they have cryptocurrency or virtual currency or digital assets, as it's sometimes called. And it's not just this, it's the sale or exchange, the use of currency to pay for goods, or the receipt of virtual currency in exchange for goods. If you have that, we're supposed to put it on your tax return. We're also supposed to ask you and check that box on your return. So in 22, the IRS brought a whole bunch of energy efficient credits to the tax returns. For years, you had a $500 lifetime limit on residential energy credits. They brought a whole bill that brought all kinds of energy credits, and these were great. There's just a lot of limitations to them. They got very confusing, so I'll do my best to simplify it as much as possible. So now, instead of having a $500 lifetime credit, you have a $1,200 annual limit credit on most of these credits. There are some that are more. It starts with, the first one is $150 for a home energy audit, 30% of the cost up to $150. So it could be more than $150, but you get $150 credit. And there's different companies that do this, but if you call DTE, I think they do it as well. They come through, tell you where you're, not efficient, and then what you can do to make it better. I believe in 2024, you have to get a PIN number to have this energy audit done and put that on your tax return. There's a $250 credit for exterior doors, 30% of the cost, up to $250 each door, maximum of $500 on doors. So that'd be 2 doors really. $600 for exterior windows, again, 30% of the cost, up to a maximum of $600. Insulation materials, 30% of the cost. And other things like furnaces, air conditioners, water heaters is a $600 max. again, 30% of the cost up to that. Now you're going to get into some bigger items like the heat pumps, biomass, geothermal, those kind of things. Again, it's 30% of the cost up to $2,000. So these are the bigger items, and you get a 30% on those. So there's a $1,200 annual limit of all these things together with all those different. So the biggest thing I could tell you about these is to make sure when you're buying any of these that they have some type of rating on them. Generally, it's an Energy Star rating is what's going to tell you that they qualify for this. Usually they'll say right on them that they qualify for this energy credit. Energy Star is a quick one. If you're doing something like solar panels or something like that, they should say that they qualify for the energy credit. I have websites I can look up or I can send to you if you want to look them up. More complicated is going to be the clean vehicle credit or, the electric car credits. These started in 22 and they changed they keep coming up with new changes on them about every 4 to 5 months. So they first came out, then they came up with a battery requirement. They came out, it had to be assembled in North America, had to have a critical minerals requirement. They added the battery requirement. It is a little bit complicated. There are lists. If you go to the IRS website, you can look up your vehicle and see if it is, most of the electric cars in 2023 do qualify, but you still have to go and check. There are a lot of requirements on this credit. It has to have a battery capacity at least 5 kilowatt. I mean, there's just all kinds of rules on this, but if you're not sure, like I said, you can go on the IRS website and look it up. You do have to, so the credit on this, you have to have enough tax. So if you want the $7,500 credit, you have to have at least $7,500 in tax. You don't get extra credit back and you can't roll it to another year. So back on this credit here, if for some reason you don't have $1,200 tax, you can roll this credit to the next year. Not this one. The vehicle credit, you can't. So if you get you will only get enough credit to cover your tax, and then it's gone. It doesn't roll on, and it doesn't. You don't get any of the credit back. So it's a $7,500 for the purchase of a new qualified electric vehicle, $4,000 for a used, or 30% of the cost. I mean, depending on. I don't think you're going to find a used electric vehicle for less than $4,000, but and then there's a credit for $1,000 for a recharging station. Now in 2022, that was $1,000 for a recharging station period. In 2023, this literally just passed like a week and a half ago. You now have to live in a certain area to take this credit, and it's basically a low income area. So you can't live in an urban area. I have a map of the areas that you have to live in. And most people that live in low income areas can't afford an electric vehicle, but that is what they've given us a general mapping area that we literally have to go on and put in your zip code to see if you qualify to get this recharging station credit. Doesn't make any sense, but that's what they've done. So if you want to qualify for that credit, you have to put your zip code in and see if you qualify for that credit. There's also an income limit on these. So your AGI in the year of purchase not the year of filing, the year of purchase has to be below 150 for single, 225 for head of household, and 300 for married. The vehicle itself cannot exceed $80,000 for vans, sport utilities, and pickups, and $55,000 for other vehicles. Starting in this year, dealerships can start giving the credit right with the purchase, which will make my life much easier. But the dealerships have to sign up and get through with the IRS. So by 2025, that will be completely automated through dealerships. 24, it's going to be hit or miss, but we're hoping that that is completely automated by the end of 24. Education tax credit. So education tax credits, the top one is strictly mostly for students who are getting a 4-year degree. It's $2,500 annually per eligible student for a 4-year post-secondary school. Income thresholds apply. But the lifetime learning credit is really available to anybody You really don't have to be pursuing a degree. You can just be anybody can take a class in an eligible university if you want to take a literature class or any other class. It just has to be an eligible school. But you can take those credits. You don't have to be pursuing a degree. You can just take classes. 529 plans. This is, there's two things to do with 529 plans. The first is you put money away for kids, but it doesn't have to be dependent on your tax return. You can save money on a 529 plan for your grandchildren, your nieces or nephews, anybody that you want. For instance, I have a 529 for my granddaughter. She's not a dependent. I can put up to $10,000 and it's taken directly off my state return. That money grows tax-free as long as she uses it for education, room and board, and it can be used for out-of-state tuition. And as long as she does, the money that it grows is completely tax-free. It can actually now also be used for tuition at public, private, or religious school all the way through elementary, secondary. So it no longer has to be used just for college. So as a grandparent, I can start an account and even her parents can put in the account and they can take the money as a deduction as well. So I start the account. It's for the benefit of her, but I'm the account owner right now. And student loan interest, there's a $2,500 deduction. There is some income thresholds on this one. On the $10,000, there is not an income threshold on that. You can put $10,000 off your state income, and there's no income threshold. On the $2,500 is student loan interest. If you are a co-signer on a loan for a kid or a grandkid, you can take that student loan interest on your return if you're paying it. If they're paying it, then obviously they're going to want to take it. A lot of people were deferring loans due to the COVID. It just started back up in fall of last year. So we're just starting to see the student loan interest again. But it doesn't have to necessarily be your loan if you're a co-account owner or a co-signer on that account and you're paying the loan, you can take the interest. We see a lot of parents that are paying kids' loans. Retirement. So in retirement for 23-24, the IRA and Roth contribution amounts $6,500 or $7,000. The catch-up amount's $1,000. You do have to have earned income to put money in an IRA, and it must be made by April 15th. The limits to do a Roth are $153 and $228 for 2023, and for 24 those amounts go up. Backdoor Roths are still allowed if your income is too high to do an IRA. You can do a Roth, you can do a traditional and then convert it. Retirement for 2020. These are some other rules. So in 23, the minimum age or the minimum age for RMDs went up from, it was 70 and a half forever. It was 70 and a half. And then in 2022, it went up to 72. In 23, it went up to 73. So these are for people who had not started their RMDs. If you hadn't started your RMDs, you could wait till you were 73 and 23 and start taking RMDs. This is for IRAs, SEPs, Simples, 401s, 403Bs, all of them. The exception is for a 401 or a 403B. If you are still working, you are not required to take RMDs out of those accounts. You are still required, if you're still working, to take it out of IRAs, SEPs, and Simples. They are exempt from that rule. If you inherited an IRA and the deceased was taking RMDs, you must continue taking RMDs. The only exemption from that is if it was a spouse and you rolled it into your IRA. That's the only exemption. If it was a non-spouse IRA, you have to clear it out in 10 years and you have to still take RMDs. A lot of people were very confused by that because in 2020, when they changed the rule that non-spouse beneficiaries had to clear it out in 10 years, they mistakenly thought because they had to clear it out in 10 years, they no longer had to take RMDs. So we had a lot of people who weren't taking RMDs. So they allowed people in 2020 to not have to pay penalties, but in 21 and 22 and now in 23, they said, no, you do have to take those RMDs. The Roth IRAs are not required to take RMDs. However, beneficiaries of Roth IRAs are required to take RMDs. They're not taxable, of course, but they don't want you leaving it in there forever to grow tax-free. The penalties for missing an RMD, they used to be 50%. They have now lowered that amount to 25%. So the amount you should have taken is penalized at 25%. So if you were supposed to take an RMD, you missed it, the penalty is 25%. Honestly, we have never seen anybody actually get a notice on that. But we tell people, if you realize that you were supposed to take an RMD and you missed it for some reason, we tell people to take it as soon as you realize that you didn't take it. The qualified charity distributions from IRAs are still allowed. You can take that up to $100,000 to defer taxability of RMDs, and we highly recommend these. If you're doing charity anyway, and the standard deductions are so high right now that a lot of people are not itemizing, it's the best way to do your charity, get the deduction on your, off of everything, the federal and the state, because it comes right off your adjusted gross income. You're doing your charity, getting a deduction for it, and still getting to write off your charity, basically. So it's a great way to cover all your bases and still make your charity deductions. This is something that has just started. They've been talking about doing it for about a year. It just finally went through. And this is going to be a lot of you probably don't have businesses, but this will also affect anybody who has a small little business, anybody who has an LLC for a rental, anybody who has started any type of small entity in the United States. So the FinCEN, which is actually the Financial Crimes Enforcement Network, has started where anybody who has any type of LLC, S Corp, or corporation in the United States has to file what they consider a BOI, a Beneficial Ownership Information Report. And you have to file this by the end of the year. It's a report, and it basically, you have to file a report saying this is what my entity, where it started, who all the people that are involved in it, any owners. So if it's one person, LLC, you have to state your name, your address, social security number, anything that would be on your driver's license or passport. If it's two people on an LLC, there's all their information. If you were entity started prior to 1/1/24, this is not due till 1/1/25. However, if you start your entity after 1/1/24, you have 90 days to file this. If you make any changes on your address or any information of any of the principals, you have to file within 30 days and notify them. The penalties for not filing this form start at $500 and go up to $3,000. So this is the government's way of trying to get a handle on all the small businesses. Anybody under $5 million has to file this, basically. So anybody $5 million or less, they're trying to get information on all the businesses in the United States. It's not filed with your tax return. These are the same people, FinCEN, who you file if you have a foreign bank account. So if you have a foreign bank account with more than $10,000 in a foreign country, FinCEN is where you have to file that tax return, notifying them that you have it. You don't have to pay tax on it. You just have to file that return and notify them that you have this money, where it's held, what the account number is, and all that stuff. They said the same organization, and we file those returns, FinCEN returns. This is the same organization, and now these returns have to be filed with all this information. So like I said, this is fairly new, and the hardest part is going to be all the people who've started little LLCs for small, little teeny businesses, never closed them, or rentals, or the such. Now we're going to talk a little bit about, there's a lot of confusion around the different modes of living that some people move to as they age and how that will affect your taxes. So the first one would be a resident of independent living. So if you rent, say, in an independent living, you have no services and you are not a licensed facility, if you meet the income requirements, and we'll get to that on a later slide, you may take your rent as a rent credit on your Michigan property tax form. If you are a resident of an adult care home, such as an assisted living facility, your facility probably pays local property tax. You can claim a portion of that on your Michigan tax return as a property tax credit, just like you would on your home that you're living in as a property tax credit. Again, you have to meet the income requirements, but you find out, and they probably send you a letter saying, this is your portion. Say you have 5% of it, so you get 5% of the taxable value and 5% of the property taxes. They send you a letter at the end of the year. You use that to file your property taxes. You cannot claim your rent because your rent is an inflated number that includes the services that you have, but you can claim a Michigan property tax credit. There are situations where you're living in an assisted living facility where one member of the party may be considered nursing. And that's because, and we have that with John right here, his wife is considered nursing. There's reasons why that. Generally, it's because a married couple wants to stay together, and that might not always be able to happen in nursing, or it sometimes happens because nursing facilities have waiting lists. Whatever the reason, if that person in the assisted care facility meets the requirements of a nursing, that's 5, they usually use a 5 term, whether they need help bathing, dressing, feeding.
680 Ls.
Yeah. If they meet those requirements, then we can drop down to the bottom one, even though they're in assisted, and all the things, lodging, meals, and medical care can be considered medical expenses on your Schedule A and considered medical. And on most people's Schedule A, a lot of people are taking a standard deduction, so they don't often keep track of their medical. But when you start considering the cost of whether it's an assisted living or a nursing home, I mean, your monthly rent is easily $12,000, whatever. You start heading up these costs, they easily will cover more than your standard deduction. So you're now in the situation where you're itemizing. So if you're in a nursing facility or a long-term care facility, and the principal reason for being there is medical care, you can take the cost of lodging, meals, and all medical care, and I mean all medical care, including all your supplies. It goes on as a medical expense. And the same with if you're in assisted living care, obviously John's expenses wouldn't count, but all of his wife's would, including the lodging and all that kind of stuff. So these are the 3 different modes of living and how you would treat those. Now, if we flip here, I'll show you right here is the property tax credit. So in those 2 instances where you could get a property tax credit, obviously your income can't be more than $67,300. That's the income limit. And the maximum taxable home value can't be more, and that's right on your property tax bills. Your taxable home value can't be more than, in 23, can't be more than $154,400. So in scenario 1 and 2, where you were in a independent living, or if you're living in your home, or if you're in assisted living and it's not considered medical, this is where the avenue you would go to is a property tax credit, potentially, if your income is below that amount. You could potentially get a property tax credit. So I get a lot of questions about these bottom 2. Do I qualify for these credits? Your income has to be fairly low. I get all kinds of questions about this bottom one, home heating credit. Almost nobody qualifies for this. I mean, if you're this income limit includes 100% of your Social Security, because even though it's not taxable in the state of Michigan, it's considered in household income. So for a single, $16,000, for a married, $21,000, that's extremely low. I mean, that's your Social Security and any other retirement or anything that you have. So it would have to, I mean, there's very few people nowadays that qualify for a home heating credit. So the state of Michigan, I don't know how many people know this. I jumped down to the bottom just because we were already talking about the property tax credit. But the Michigan tax rate did reduce in 2023 from 4.25% down to 4.05%. And the personal exemption went up to $5,400. It goes up every year, same as the IRS, slightly for inflation. You do get a deduction in the state of Michigan for, it's called the Senior Interest Dividend Capital Gain Credit. However, they take this off your pension and retirement credit. So if you're already maxing out your pension and retirement credit, you don't get this. So now we're going to get into a really complicated pension retirement in the state of Michigan. If you were born before 1946, you're golden because nothing has changed for you. So if you're born before 1946, yep, I'll see, there you go. If you're born before 46 or your spouse was born before 1946, you were grandfathered into the old rules that have never changed. You have a single exemption that changes slightly every year, goes up for inflation. This year, the single exemption is $61,518 and the married exemption is $123,036. The only difference in this one is if you have a public retirement, that would be a teacher, a firefighter, or a police officer. They have unlimited only on their pension. Their other retirement would fall into the top category of 61 and 123. In 2012, they changed the rules because there were so many auto workers retiring early. So in 2012, they decided if you were not 66, you had to wait till you were 66 to get your retirement, and then you got $20,000 if you were single, $40,000 exemption if you were married, and it was all your income, not just retirement. So you just got this blanket deduction on all your retirement. Then, now in 2023, they passed this law. The problem is it took them so long to pass the law that it technically didn't go through till the middle or end of February. So we're not sure what's exactly going to happen with the software because it hasn't actually changed yet. So we're not sure. But if you see this asterisk now, so this is, in fact, if you remember, in 2022, it was supposed to pass and it didn't pass. So in 2022, it never passed. That's what Whitmore ran on in her election last time, was that she was going to reenact the old pension laws, and it never happened in 22. So in 23, it finally happened, but late. So we're waiting to see when this actually does go through on our software. But if you look at the asterisks, this is how it changed. So 46 to 52 is now 46 to 58. And the first year, it's 25% of retirement. Now, when I say retirement in the state of Michigan, this is going to be IRAs, 401ks, 403bs, insurance products, annuities, anything that's going to show up on a 1099-R. They consider all of that retirement income. This is anything that's not, this is anything that they consider retirement. So what's going to happen in the crossover year of 23? You get to do whatever's best for you. 20% or $20,000 for a single filer, $40,000 for a married filer, or 25% of retirement up to the old limits. Then the other thing they added back was this no age requirement, must be qualified, fire and police only. So they left out the teachers and the mail carriers. Why they did that, I don't know. It used to just be public retirement. Now it's police and fire retires only. I don't understand that. But so that's this. The two asterisks are what they added. And they also added in 53 to 56, the standard 2040 is retirement only. They took away that all income. So the 2040 is now just retirement. They took away the 2040 across all income. So I know this is kind of confusing. I tried to put it in this slide a little bit down so you could see what's coming. So in the crossover year of 23, if you're over 77, you still get that full amount, which is $61,000 retirement income, $123 married, and you're going to keep getting the full amount every year, no matter what that is. If you were born between 46 and 58, you're going to slowly be grandfathered in. So this year you'll get 25%, 50%, 75%. By 2026, you're going to be the same as the people born before 45. The 59 to 62, which are the people currently 61 to 66, they don't have any exemption this year, but next year they're going to get 50%, then 75%, then they're going to get the full amount. So slowly they're adding everybody in. So by the 2026, everybody will have the full exemption that the born before 46 people have. Okay, security IP PIN numbers. We have several clients that have these. There's two ways to get a security IP PIN number. The first way is to have ID theft or to get theft on your return. Doesn't happen as often anymore. We've been putting people's driver's license information on. When you do that, it does give an extra security on your tax returns. Why we ask you for them, because it does give the IRS that. So if somebody else files a return, it knows that it should have that, and then it's less likely that somebody's going to steal your social security number and file a return with that information. More likely now we're seeing with people taking children as dependents before you can file your tax return. You know, obviously everybody stresses across the board to be very careful with your information. But that is one way. If you've had some type of, in the past, if you've had some type of security on your tax return, the IRS will issue you an ID security PIN. And once you get one, they'll send it to you every year with a piece of paper, probably in January, that you have to bring to us, and we have to put that in your tax return to file your tax return. The second way is if you just want to be safe with your tax return, you can go on the IRS website and request one. You go on the IRS www.irs.gov. It's right on the front page. Keep in mind, if you get it because you've had some problem with your tax return, the IRS will eventually, after a few years, decide you're safe and stop sending them. If you opt into it on your own, you have to go in each year and request your new PIN. We cannot file your tax return without it. We do have a lot of security measures at our office. There are a lot of people who go south or are not in this location. So if you do need to send us data, don't email it. We do have a secure format that you can upload information. We can send you a secure link that you can upload your data. It is protected. We can also send you a copy of your tax return if you need it for some reason through the same format. So we have 3 admins up front. They use the same email. It's called info@huntercpagroup.com. You can either call our office or email at that email. It's checked every day, and they will either send you a link. It's good for 30 days. If you need more time than that, they'll send you another link. You can attach approximately 30 documents to that link. If you need another link, they'll send it to you. So if you're sending your information, that is a secure way to do it. You can obviously drop off your information or make an appointment. But if you're trying to do a secure link, that's a good way to do it. Don't email your stuff ever through just a regular email. If clients ever do that, I always delete, take the information, delete it, and call them and tell them that's not the safest way to send it. Taxes this year are due on April 15th. We haven't had that in quite some time due to weekends and Patriots Day, which is right around April 15th. If you file an extension, it is due October 15th. Yeah. If you want to only receive a PDF copy, a lot of people are doing that nowadays. They don't want a lot of paper. Let us know up front so we don't print it before then. Let us know when you come for an appointment, or email your docs or drop them off. We do have to have a signed engagement letter and a signed 8879. Because we are a public firm, I'm peer reviewed. I do have to have both of those signatures signed. We now have DocuSign, so we can get those forms signed electronically. I think in the past you've had to print them off, sign them, and scan them and send them back. We no longer have to do that. You can do that directly from the system when we send them to you. So if you want to sign those electronically, you can now do that. But we must have both of those in the engagement letter to do the return and the 8879 to file the return. And the reason we do that, like the 8879, what you're signing for the engagement letter is that you understand the process, and the 8879 acknowledges that you've reviewed the return and you want it filed. So that's what those forms are saying.
And you can do that when you pick up the form?
Yes, you can. Yes,
Yeah.
you can still do that when you pick up. Yeah, you can just sign it by paper. Good old-fashioned paper. All right, thank you very much. Have a good day.
Thank you.
I'm going to just wrap up with a couple of things here. First off, that our next webinar, and Dan and I talked about changing this a little bit. Be honest, we've had little participation, lower than we expected, on the actual live Thursday, once a month webinars. So we're changing formats. We're going to record it. We're going to send it out the same time, but you're going to get an email with a link to just go watch it when you want to watch it. Okay? So no more trying to figure out how to get to YouTube or to get on Zoom, anything like that. You'll have the direct link and can watch it at your convenience. If you have questions, give us a call right after you're reviewing it. Okay? And our next in-house workshop is going to be Thursday, March 14th and Friday, March 15th. So that's when we're going to kind of go over the market for 2023, what we're seeing for 2024 moving forward, and you know what we're looking for from an investment standpoint and stuff like that. So the economy, the markets, and how to invest, we'll be doing that in March. So wrapping it up, there's no reason for you to worry. You take care of your family, and we'll take care of the Detroit Lions on Sunday. So anyways, thank you for coming. I hope you enjoy your weekend.